There is a number. A single, specific number sitting somewhere in your future. And until you hit it, compounding will look like it's barely working. It will look slow. It will look boring. It will look like it isn't doing anything at all. But the moment you cross that number, everything changes. The same math, the same interest rate, the same monthly contribution, suddenly starts moving so fast it looks like a different formula entirely. Most people quit investing before they ever reach that number. Not because the strategy failed. Because they never understood there was a threshold to begin with. Today I'm going to show you exactly where that threshold sits, why it exists, and why almost everyone gives up right before they hit it. Let's start with what everyone already believes about compounding, because it's technically true and completely misleading at the same time. You've heard the pitch. Put in $100 a month, let it sit for 30 years, and thanks to the miracle of compound interest, you'll retire a millionaire. Financial influencers show you the chart. It's the one that starts flat near the bottom left and rockets up toward the top right like a hockey stick. That chart is real. The math behind it is real. But here's what nobody tells you when they show you that picture. They're showing you the entire 30-year journey compressed into one image. What they are not showing you is what it actually feels like to live through the first 15 years of that chart, back when the line is still hugging the bottom of the screen. Because for most of that time, compounding isn't rewarding you. It's testing you. Picture two people. Person A starts investing at 25. Person B starts at 35. Both put in the same amount every month. Both get the same average return. For the first several years, Person A feels like an idiot. Their balance creeps up by a few $100s a month. They check the account, and it barely looks different from the month before. Meanwhile, their friends are buying new cars, taking vacations, upgrading apartments. Person A is sitting there with a brokerage account that looks, frankly, unimpressive. They start to wonder if they're doing something wrong. They start to wonder if this whole compounding thing is a myth sold to them by people trying to sell courses and financial products. Some of them quit right there. They pull the money out, or they stop contributing, or they shift into something that promises faster results. And that decision, made in year 6 or year 8 out of sheer impatience, is the single most expensive financial decision most people will ever make. And they'll never even realize they made it, because you can't see the money you didn't lose. The tragedy isn't that compounding failed them. It's that they left the game one lap before the number that would have changed everything. So let's actually do the math, because the specifics matter here. Say you invest $400 a month at an average annual return of 10%, which is roughly the long-term historical average of the S&P 500 before inflation. Now here's where it gets interesting. Look at what happens between year 20 and year 25. Your contributions in that 5-year stretch add $24,000 to the account. But the growth from interest in that same 5-year window adds well over $100,000. The interest isn't just outpacing your contributions anymore. It's lapping them. Let's push a little further, because the shift between year 10 and year 20 is where most people's intuition completely breaks down. By year 15, your total contributions sit at $72,000. Your account balance, though, is closer to $142,000. Interest has now added $70,000. For the first time, the growth from compounding has caught up to and slightly overtaken the money you personally put in. By year 20, contributions total $96,000. The account sits around $275,000. Interest has contributed roughly $179,000, almost double what you've personally deposited. And this is with the exact same monthly amount you started with in year 1. You didn't increase your contribution. You didn't take on more risk. You just stayed in long enough for the math to change shape underneath you. Here's the number nobody tells you about. The threshold. In almost every realistic compounding scenario, reasonable contribution, reasonable return, reasonable timeline, there is a specific point where your annual interest earned finally exceeds your annual contribution. Before that point, you are the one doing the heavy lifting. After that point, your money is doing the heavy lifting, and you're just along for the ride. In the example we just walked through, that point lands right around year 14. Before year 14, Every dollar of growth in your account is mostly coming from you. After year 14, your money starts earning more in a single year than you're putting in with your own paycheck. That is the hidden cost of quitting early. It's not that you lose the money you already put in, you usually keep that. What you actually lose is access to the version of the curve where your money starts working harder than you do. You're paying, in years of discipline, for a ticket to a party you leave 5 minutes before it starts. And here's the part that should genuinely bother you. The median investor doesn't make it to year 14. Study after study on investor behavior, from fund flow data to 401k withdrawal patterns, shows that most people either stop contributing, cash out, or drastically reduce their investing during a market downturn, and those downturns statistically cluster in exactly the window before the threshold. When the account is still small enough that a 10% drop looks scary in dollar terms even though it's mathematically tiny compared to what's coming, you are most likely to quit right when quitting costs you the most. There's a second, quieter cost hiding inside the first one, and it's about time, not money. Compounding doesn't just reward the dollars you leave in the account, it rewards the years those dollars are allowed to sit untouched. Pull $10,000 out in year 8 to cover an emergency or a better opportunity. And you're not just removing $10,000 from your future balance. You're removing every single year of growth that money would have generated between year 8 and year 30. A withdrawal in year 8 can end up costing you 6, 7, sometimes 8 times its own value by the time you would have reached year 30. The number on the screen when you withdraw is never the real cost. Now, I want to be fair here, because it would be dishonest to make this sound like a guaranteed outcome if you just grit your teeth and wait. 10% average annual return is a long-term historical average, not a promise. Along the way there will be years where the market drops 20, 30, even 40%. There will be a year where your account, instead of growing, shrinks by tens of thousands of dollars in a matter of months. The threshold we talked about isn't a smooth on-ramp. It's a jagged, uneven climb with real drawdowns built into it. Anyone who shows you a perfectly smooth exponential curve and calls it realistic is selling you a simplified version of reality. It's also worth saying plainly, not everyone has $400 a month of disposable income to invest, especially not early in their career, especially not with rent, debt, and the actual cost of living in 2026. The math works the same regardless of the dollar amount. The threshold shows up whether you're investing $50 a month or $4,000. But the emotional weight of just be patient for 14 years lands very differently depending on your starting point. This isn't a lecture about willpower. It's a description of how the math behaves once you're in the game, whatever amount you can actually afford to put in, and the number 14 itself isn't fixed. It moves depending on your contribution size and your rate of return. Higher contributions and higher returns pull the threshold earlier. Lower contributions and more conservative returns push it later. The exact year matters less than the shape. There is always a point, and it's always further out than people expect, and it's always closer than it feels while you're living through the slow part. There's also a version of this conversation that ignores taxes and fees, and I don't want to pretend those don't exist. A tax-advantaged account like a 401k or an IRA lets the full curve play out untouched.